Welcome to Life Planning 101, brought to you by Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
This is another episode of Black and White Market Chatter, Life Planning 101. One of our challenges that we face is when we publish these podcasts, we're usually limited on time. And so one of the things we wanted to do today is follow up on some concepts that we've not quite been able to get through on our last couple of episodes. So we hope you enjoy this. We want to pick the conversation right up. And I just want to say none of this is considered a recommendation. It's a strategy. It's a thought, something we're working to trying to apply in our investment practices. But we invest each person individually per their risk, and that none of that will change. So if you have questions, please first and foremost call us. We'd love to visit with you about your individual situation. But now that we've been through that, Aaron, talk to me about one of the ways that we want to be defensive through some of this froth.
All right. Just toss me a softball right there.
Boom!
All right. So, we're in a pretty remarkable time. We are definitely in this inflationary period. Government is printing lots of money, and all that money is going into the system, and the market is going up. This is good times for the stock market, and we've had a great run. So how do we protect what we have at this point? And when we actually look at the inner workings of the market, we can see lots of froth. Lots of the technology companies out there are just out of this world expensive. And one of the biggest arguments against that is, well, interest rates are nothing, so these growth companies should be worth more. And I agree, they should be worth more. But if you have a company that's trading at hundreds of times sales, maybe that's a little bit strange.
Well, you have to look at it and say, what are they going to do out in the future, right? Because It's all about discounting, and if they're using discount rates at these current interest rates, there was, and forgive me, I don't remember exactly who said it, but they said if you want a discount at 0.5%, expect to make 0.5%.
Yeah, I think that was Howard Marks.
Is that okay? There you go. Forgive me, but yes, it was. But that was a very profound thing.
You have to choose the correct discount rate for what you're trying to get. That's very good. But anyways, we're looking at a time at a lot of stocks that we haven't seen this kind of pricing since 2000. Now remember what happened in 2000, 2001, 2002. The NASDAQ, which was made up of most of these tech companies, dropped about 30% a year. Lost 90% of its value in a 3% or a 3-year time frame. And I'm not saying that's going to happen. It's definitely a different market. The companies are making money. Most of them are.
Right. But
that expensive?
But go back to the basics. When the market's up, we capture profits, stick them away for a rainy day, and look for other opportunities. Yes. It's no different. That's exactly what we're doing. Right.
So, we want to do just that right now. Let's capture some of our gains, get ready for the next leg, see what's out there, but while we're printing, we don't want to miss out.
It's too painful.
Yeah. They have this thing called don't fight the Fed. And nobody can fight the Fed.
No.
I mean, they've thrown trillions and trillions of dollars at the market just in the last year. Nobody can stand in the way of that. So while they're being easy and while we're printing money, we need to get as much as we can. And another way to think about that is that they're printing all this money. We're going to have to pay it back. My taxes are going up. My kids' taxes are going up. My grandkids, we're all going to pay for this. So I might as well get as much of the return as I can. But how do I do that with less risk?
Well, you can't just take it out of the market and park it in cash or treasuries or something like that.
Right.
We talked about that being a going backwards vehicle and everything going forward is 18. We're flying the other way.
Right.
So you have to have a way to keep up with that in some regard.
Right. So one way we're looking at it is we're trying to position ourselves with more of a defined outcome. What is the amount that we're willing to lose? And if we can set that up, if I can set up my portfolio that I know that that's the part that's in the market, and even if whatever happens, that's the only amount I can lose, I feel more comfortable with that.
Right.
So for example, we're using some different instruments and holding about anywhere from 7 to 15% of our portfolio in these instruments, and they're long, deep in the money call options, and those should give me the return of the market, or very close, somewhere 80 to 85% of if the market goes up. But if the market goes down, if the market drops 50, all I'm losing is what I have in there, and I'm keeping it at these levels that I feel comfortable with losing all of.
So put that in so I can take a smaller amount and buy, options as you're buying the growth, right?
Right.
So we're not buying the instrument, or we're buying the growth on something. If that growth doesn't take place, I lose it. It's like, so if I
lose it.
if
100%.
it's like all on black.
Yeah.
If it comes out red, it doesn't work. If it comes out black, I'm going to make some money. Now,
But think of our roulette wheel. 70% of it is black. If black is up,
right.
70% of the time the market's up. So we are putting our money on black, but we're only putting enough that we're willing to lose.
Right.
So let's just use 15%. I'm willing to lose 15% of my portfolio. I could keep 85% in cash and the other 15% in these options. And that 15% should generate 80 to 85% of whatever the market does to the upside. But if the market drops 50%, guess what I lost? I lost my option, which was only 15%. Market drops 30, only lose 15%. Market loses 20, only lose 15%. Market loses 10, I still lose 15%.
Right.
That's kind of in that risk area. But
Go back to the stress test,
more of a defined outcome that I'm comfortable with. And I'm not giving up. I'm still in the market, and I'm still investing. But I can reduce my risk and get a better return than being in bonds and cash, which is a loser's game at this point.
Yeah, it's definitely going backwards. So what you think about when we talk to people about risk and their stress test, right? We go through it and we say, if this happens in time, your portfolio would go down this much. Are you okay with that? Could you sleep at night? This is the same thing.
Same exact thing.
We take we expose as much as we want to that strategy, the call option strategy, and we say, I'm comfortable with it going down this much, with the ability to, over time, go up 80 to 85% of the market, right?
And it's with a contract.
Right, contractual. Yeah.
It's a contract. So that I can only lose out on what contract I wrote,
Right.
which is pretty dang powerful.
Right.
Pretty dang powerful. And you mentioned something on the stress test and everything else. We do have defined outcomes. We can limit our losses to the amount that we have in those contracts, but it doesn't change the volatility of the portfolio. Though the portfolio is still going to be as volatile as being in the market. We're just going to lower the downside of what can actually happen.
So if we want to be defensive, we're going to basically try to lose less than the market,
Yes.
right? We're still...
That's the way to win the game, is lose less.
We're still going to try to get some growth, and if you want return, you have to be willing to risk assets, and so we're going to still have...
Yeah, we need more than the risk-free rate, and the risk-free rate is 0, and that's what you get if you don't do anything.
Right.
So how do we beat that?
Right.
This is one way to do it, and that's from a defensive standpoint.
Right.
So if you're terrified, if you're not sure of what to do, you can take your gains, you can capture those,
Right.
Get safe with a big chunk of that money and still not give up on your long-term goals.
Right. And it doesn't even have to be, it could be a lot of different things, right? Because it could be that you don't have near the years of earning or growth available to you, right?
Yes.
You may just decide that, I want to continue to move up, but I'm not going to have large cash flows in my portfolio.
Right. And people like that are not comfortable with their portfolio dropping 50%.
Right.
That's devastating.
Right.
So that's really what we're trying to keep from happening.
Right.
Is those devastating losses for people that can't afford it.
Right. We're trying to help keep people retired. We talk about it all the time. So, okay, so that gets us defensive, but what about the folks that don't want to be in, 85% cash is quite a bit.
That's a lot.
For somebody that's maybe more aggressive or wants to be, it doesn't have to be aggressive. It could just, you want more growth potential.
Right. So, I'm actually doing this strategy, and I'm the opposite of defensive. I'm pretty much as aggressive as it comes, and I can use a very, very similar strategy. And what I'm doing is I'm still capturing my gains, and I'm writing similar contracts, but my contracts are to ensure that I don't miss out if the market goes up. I'm simply buying an insurance on market gains. That's kind of powerful. If the market continues to go up, I want it.
Right.
So I'm buying this insurance on gains and not giving up. And what I'm doing a little bit different, and what the mindset is I've got this buying power in my portfolio now. I didn't do everything. I did 50 to 60% regular everyday investing, but the other part, I'm trying to get some cash on the sidelines, because there's lots of moving parts right now, whether it's the Fed raising interest rates, whether they slow down on the quantitative easing. What the heck is China going to do?
It's changing. And then you see the short-term volatility in the market, and one of these days it could turn into something more than one day. But even that, cash is king, right? We say that all the time.
Cash is king.
If you want to take care of an opportunity, you got to have it sitting there.
Yes. And I have a good feeling that something's going to screw up along the way. And, typical money management is market tanks. Let's say the market's down 30%. I'll be digging through the portfolio looking for something that's down 20, so I can sell that, take my 20% loss, and buy something that maybe is down 40, and get the ride back up. That works, but it doesn't change the volatility or the overall 20% loss. So what if I wanted to sell something that was down very marginally, or maybe not down at all, to buy something that has a huge discount? Right. That's the way I'm looking at it, is I want money on the sidelines for when things really break down. I can go in and make a great purchase by a great company or a great sector, a great industry, when it's really beat up. When there's blood on the streets, that's where I want to be buying. And I can capture that purchasing power while I still have my insurance premium over there to insure against the market continuing to go up and me missing out on a whole bunch of returns.
You say it all the time, and we know this. There's no timing the market.
No.
And I think if we can drive a point home, I think that's what you're saying here, is that the market's frothy. Back in 2020, we did what you said. Something that was down 10, we sold that and bought something that was down 20. And people did well. That was beneficial. Sitting on your hands during that time would have been foolish. And I think to the point, we were probably more active in 2020 than we were
any other time in history.
That's right. trying to get those opportunities. And what that did is got us thinking of, okay, so how could we, you always want to reflect, what did I do and what could I do better? I think that's what got us here is, we're getting into some frothy space, but it's like, how can we drive peace, comfortability in the portfolios and get people comfortable with their portfolio? Because the biggest thing is you got to stay invested.
It's got to stay invested.
Some people will jump in and out, and that's the most harmful thing with anything, with any strategy. Whether you're in CDs, whether you're in high volatile equities, jumping on and off of that roller coaster at the wrong time hurts. So this is a way to build a little buying power.
Yeah. Stay invested, guys. Don't give up. We've got to be in this for the long term. And the name of the game is limiting downside. And there's ways to limit downside without giving up on your future.
Right.
And that's where I've seen the most pain for people is when we have outsized volatility in the market and they sell and go to cash, or they really let their emotions drive their decisions and they hurt themselves permanently.
Right.
And that's the one thing we do not want to do. Yeah. And I know a lot of the things that we're talking about are maybe new to our audience, but they've been around since basically the beginning of the market.
Well, we've been implementing these strategies personally for a long time, and
yes.
That's what Aaron was saying earlier. Is we use his portfolio as a guinea pig to make sure it's going to work, right? And because we are T-ball, our firm is T-ball,
yes.
And this is a way to continue to be T-ball.
I think the most important asset that really anybody has in the investment world is time.
That's right.
Even Albert Einstein, what he say? Compound interest is the eighth wonder of the world.
Oh, but that's true.
It is.
I mean, it's very true.
And it's time. So if I can keep somebody invested over time, that is my goal.
Right.
That is my goal. I'm not looking to outperform the market by so many percentage points a year or a month or a week. That's a fool's errand. We can't do that. But if I can compound your assets at 6% or 10%, or whatever your risk number is, whatever you're comfortable with from a risk level, that's where we need to focus. And the only way we're going to do that is keep you invested over time.
Right. Help you sleep at night.
That's right. So we got lots of tools that we can use, and this is probably the most exciting one that we're talking about in this time period.
Right. So we need, if there's questions on this, you got to call us. We have to visit with you. We want to help you personally because everybody's portfolio and everybody's situation is unique, right?
Everybody's different.
There's no cookie cutter thing about your life or your plan, and this will slice into your plan very uniquely again. So we want to take care of you, and we got to visit about it.
Yes, we need to visit. We need to go over the ups and the downs and the risks and the rewards, because not everything's a reward all the time.
That's right. So Aaron, anything else you want to add before we wrap up here on this exclusive for Black and White Market Chatter?
Good. Everybody have a great time with their family over Thanksgiving. I just pray everybody's has the ability to be around the ones that they love.
And be safe. Okay, that concludes our episode today of Black and White Market Chatter right here on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton and Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton and Associates Incorporated.